Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 30 years experience working in the oil and natural gas industry. He's a former senior executive at Hess Oil. He currently runs the Energy Prospectus Group, which is a in-person meeting and newsletter covering oil and natural gas companies, mostly small and mid-cap companies, but he also has the Sweet 16 of mid-sized companies that are mostly independents, not the large big oil companies like ExxonMobil or Chevron. Dan Steffens, thank you for joining me.
Yeah, thanks for having me again.
So, Dan, we're recording this interview on February 3rd, 2023. The oil price, the WTI oil price is at $73.17. It's been range bound for a while. It's down significantly over the last 6 to 8 months. A lot of that Russia-Ukraine invasion premium has come out of it, but it's still at a pretty healthy price. There's been some interesting comments, though, from the Saudi oil minister lately, saying that if China does reopen and a lot of Chinese manufacturing, a lot of Chinese travel for either business or for vacations with diesel fuel and jet fuel and these other consumptions start coming back online, all the spare capacity for oil will be gone very quickly. So what's your opinion on the oil price the last 6 to 8 months?
Well, everybody's got to remember that demand for oil is seasonal, and it's a global market. The price is set by global supply and demand, and the demand for oil-based products is always the lowest in the first quarter of the year. And the reason that is because with the weather, and you have 90% of humans live in the northern hemisphere, and after you get past the holiday season of Thanksgiving, Christmas, the travel just really drops down. People kind of hunker down to get through the winter. And the price just pulls back naturally. But then as soon as you get into the spring, travel picks up. You have, kids getting out of school for a week or something, and spring breaks starts happening and people start traveling again. And then it really jumps up. And also, we use a lot of diesel for the planting season. So a lot of farm equipment runs on oil-based products too. And so then you get this 2 or 3 million barrel a day increase in the spike of oil in demand. And then also, in the United States, we have winter blend gasolines and summer blend gasolines. Well, the summer blend gasolines require more crude oil. You cannot blend in butane and stuff into summer blend gasoline. And so that alone adds like 1 million barrels a day of production. But I think one of the reasons it's pulled back is because all these sanctions and price caps against Russia, they don't seem to be taking any oil off the market. And that's because these countries like China and India, they're going to buy every barrel of oil they can get at cheap prices from Russia. They're not afraid of, anything Team Biden's going to do or anything the European Union's going to do to them. So Russia is able to find buyers for their products. Now, the price caps and some restrictions that are going in on refined products, that goes into like on February the 5th or 6th next week. So we'll just see. I don't know, but I think the market has little faith that these things are going to limit Russian production. But now on the other side of that, I really think that OPEC is kind of peaked out on production. You take the old cartel, and they're not producing up to their quotas. Even last month, Saudi Arabia did not produce up to their quotas. So you kind of wonder if they really do have any excess capacity, and if they do, it's not very much.
I think when you add in all the OPEC plus numbers, really since August or September, it's down over 3 million barrels per day. So, I mean, it's starting to fall off a cliff, but a lot of these hedge fund managers, these short-term global macro guys have been very short energy because they're saying global recession, China's offline. So we're just going to short all energy plays. So for the last couple quarters, especially natural gas, and we'll talk about that in a little bit, that has worked. Not necessarily with some of these large cap oil stocks like ExxonMobil or Chevron, which are posting absolutely amazing earnings for the full year 2022. I think big oil had a record profit, but now you're hearing like the European Union talking about trying to force ExxonMobil and others to legally allocate a lot of extra capital from the free cash flow. Either they want to tax it more with windfall profits, or they want to force them to invest in ESG. Now there's a big legal battle in the European Union over that.
Yeah. And all I could tell you is if you tax something, if you raise tax on something, you get less of it. So if they think that's going to reduce the price of oil to consumers, I think they're crazy.
Well,
And
wouldn't
this
you
last
say?
week, one of the reasons that they gave for the oil price being down during this first few days of February is because the EIA reported a build of like 4 million barrels in the U.S. crude oil inventory. Well, one of the reasons that's happened, or the reason it happened, I think, is because a lot of the refineries we're only running at about 85% of refining capacity because they're doing a lot of way overdue maintenance. And then that winter storm Elliott in December did some damage to some of the refineries down here. So we have some of our refining capacity offline. So guess what happens? The crude oil inventory is going to build up. But our inventory of gasoline is 7% below normal. Our inventory of distillates, which is diesel and home heating oil, is down 17%. And here we're down 17%, and you got just a month or couple months away from the planting season where we're going to need a lot of diesel and also, all these 18-wheelers run on diesel. So we cannot fix our supply chain problems without it. This country runs on diesel.
Well, also to plug the hole in the global supply gap for diesel, a lot of the U.S. oil refiners, because the laws were changed, a couple of years ago, they were exporting enormous amounts of diesel outside the United States. So that was causing the domestic price here in the United States to be much higher because the refiners were exporting it for enormous profits.
Yeah, yeah.
But would you say, though, that it's kind of like the middle finger, these large oil company executives at Chevron, ExxonMobil, and they're announcing over the last 6 weeks or so, big increases still in dividends, big share buyback programs. So they want to do that because that's a more efficient use of capital than reinvesting a lot into their businesses with high capex bills when the politicians are threatening with these ESG policies that you have to allocate capital to these types of wind, solar, or biofuels, or they're threatening windfall profits taxes. So these executives at the large companies are saying, hey, wait a minute, rather than investing in those things or getting taxed more, we're just going to hand capital back to shareholders instead.
Yeah, and the Wall Street's been really pressuring them, or investor groups been pressuring them to pay out more dividends and do the the share buybacks. I bet you half the companies that I follow, upstream companies, have got pretty significant share buyback program going, and some of them are going to be reducing their outstanding stock by like 10% per year, which significantly impacts the per share net income and per share cash flow. But boy, these companies, even if you assume $70 oil for the entire year, they are producing tremendous cash flow, free cash flow. They hold a lot of their good acreage is already held by production, so they don't have to drill a bunch of wells now. And they're just being more prudent. And for one thing, I mean, all the good rigs are working now. They really can't ramp up drilling activity too much more. We're probably only like 15 or 20 rigs, high quality rigs are even available in the market today.
Can these exploration and production companies that are producing oil and natural gas, can they lock in a lot of their drilling costs so they're not exposed to as much inflation? Because the reason I ask this is because in the last 10 days, we had Schlumberger, which is the world's largest oil services and drilling company. For our listeners who are not familiar, they announced their Q4 earnings, and they said that they're going to be raising prices again on drilling and a lot of their other oil services. So are there ways for the oil companies to protect themselves from these cost increases?
They can do some, hedging on steel too. They'd use a lot of tubulars. So they can do some of that. Now with rigs in such demand, it's going to be hard to negotiate, a long-term fixed price for a rig. Now that depends. Now, if you're using not these big rigs that, walking rigs that drill the big horizontal wells, if you're just drilling, shallower wells, yeah, those rigs are available and you could lock in those. A couple of the little Canadian companies that I follow, they actually started their 2023 drilling program early to take advantage of locking in some rig rates. But they're, only talking about a 3 to 4 well drilling program in the winter that they weren't really contemplating doing. So it's not that big of a deal. But yeah, right now, the oilfield service companies were giving them great breaks, just to stay in business. And, now they have the pricing power. So there is going to be 10, 15% increase in well drilling and completion costs this year. But remember, they drilled a lot of them now that they're making good prices on that they drilled for pretty cheap prices over the last few years.
The reason I ask that is the relative performance in the oil industry. The shares that seem to be doing well the last couple of weeks, more than a lot of the others, are the oil service companies, especially on the back of the Schlumberger announcement that they're raising prices. So Wall Street really liked that they're going to be raising prices, and that's going to help profit margins. That business is robust, demand is robust for a lot of their either drilling services or other oil services. And then also, surprisingly, even though the oil price has been kind of range bound for the last like 4 or 5 months, is deep water. So you're seeing companies like Transocean and others, those shares are up enormously the last 6 or so months. Deep water is actually getting a lot of business too.
Yeah, when it's going good, it goes real good for the drilling companies. So yeah, you might look at Helmerich and Payne, Patterson. I looked at Precision Drilling. They're based up in Canada, but they look really good now. So the actual drilling companies, there's one small cap, very niche players called Solaris Oilfield Infrastructure, and they have gained market share during the pandemic because a lot of their competitors went out of business. But they have equipment and software and stuff for handling and managing frac sand at the well site. And what they have done is significantly reduce the cost of completing wells. They're not a sand company. They don't sell sand. They just manage it at the well site. And they've really gained a lot of market share. And the company's virtually debt free. I mean, their current assets exceed total debt, and they pay a nice dividend. And I think the stock's up about 20% or so, but it's still trading. My valuation is $14.50. It's trading at about $10 now. So there's about 40% upside in the stock.
So before we transition to natural gas and talk about all the craziness that's happened, it's literally a roller coaster. And it's been called the Widowmaker trade in the last 8 weeks with the U.S. natural gas futures price. I mean, the long-term LNG contracts and the natural gas price outside the United States, especially in Asia and Europe, are still very high on a relative basis. I want to ask you about oil royalty companies. So there's been a consolidation the last 6 to 8 months in the oil royalty sector. I think one of the largest ones, Cintio, merged with another. I think on the last interview, you talked about Venom.
Brigham. Right? I like Citio. STR is a symbol. They have completed their merger with Brigham, and I've known the Brigham family for decades. I was very surprised to see them sell the company, actually, but they got a good price, and they pay about a 9.5% dividend, and they've got growing production. There's a lot of drilling on their minerals. So they don't have drilling costs. They don't have operating expenses. They just get royalties, and they have growing production, pretty steady. My forecast on that one looks really good. I don't know where it closed on the 3rd, but last week it was at $27.60. My current valuation is $32, but I'm still waiting to see their guidance for this year. If their guidance matches up with my forecast, I'll raise the multiple that I value it at.
Well, it makes more sense for these royalty companies to merge, so there's more diversification. And the more cash flow they have, the more diversification and growth they have, especially near-term cash flow growth, the more access to cheaper cost of capital and cheaper debt they get to grow. So they can. So it makes more sense from a shareholder perspective to have a total combined company that has more diversification and more cash flow growth and things like that. And then that
merger with Brigham was an all stock deal, so they did not have to lay out any cash to get that.
So for listeners who are not familiar with that business model, it's a little bit different than a precious metal royalty and streaming company. So they really only get the extra cash flow if there's drilling on the land, right? With the royalty. But there's downside protection because unlike an ExxonMobil or Chevron or one of your mid-tier oil and natural gas producers in your Sweet 16, they don't get all these CapEx bills for drilling new wells or maintenance CapEx. So maintaining well production.
Yeah, and they own minerals, and those minerals don't expire. These aren't like leases; they own minerals forever, and those and once those minerals get developed, the minerals themselves have got tremendous value to either sell to another royalty company or whatever. But and most of them do hedge quite a bit of their production. on the gas side, Blackstone Minerals, I looked at it the other day, and they have over half of their gas production for this year hedged at some pretty good prices. And their balance sheet is like pristine now. They've paid off a lot of debt in the last couple of years, and their dividend yield, the last time I looked at it, was 11.6%. So it is an MLP, though. It's not a C Corp, so it's an MLP. And I know some people don't like to own those, but the symbol is BSM.
There's not that many of these oil and natural gas royalty companies anymore. There's been a pretty good size amount of mergers and acquisitions in that space, similar to precious metal royalty and streaming over the last 6 to 12 months, right? I know that Cintio was rolling up a number of these. So before they merged with Brigham, I think they took out a couple other smaller ones, and I think Venom even may have done an acquisition.
They Venom's buying up people too, but Venom gets most of their minerals from Diamondback Energy. That was a spin out from Diamondback, which is symbol is Fang, and so Viper's symbol is Venom, VNOM.
So for our listeners who are worried about some of the cost increases that we were talking about earlier with the oil service companies, raising costs, then the oil royalty companies would be less susceptible to that. So there's more downside protection, better profit margins, although they're not generating as much free cash flow as, say, precious metal royalty and streaming company like Franco-Nevada or Wheaton Precious Metals or Sandstorm Gold, because their costs aren't necessarily fixed, and there has to be a certain amount of oil and natural gas drilling, or they don't get cash flow from their royalties.
Right.
So now I want to transition to natural gas. I wanted to talk about natural gas the most because all the craziness that's happened the last 8 weeks. We're down at $2.40. I mean, it's shocking.
Yeah, it is shocking. Hey, I would tell you that 6 weeks ago, I thought $6 would be the floor. You never know. But then we have the mildest January in the history of the United States, the first 3 weeks of January. And that took the price way down. And here, let me just, for your readers, just tell you what I think's happened. This is my theory, and I've been watching this for 40 years. So once the utility companies that supply the gas to your home or business and the gas lines that come to your house, once they believe they have enough gas in storage to make it through the winter, then they withdraw. They withdraw from bidding on NYMEX futures contracts. The gas price you see in the paper is the front month NYMEX futures contract price. So in February, the front month is the March contract. Well, the utilities all believe they have enough gas to make it through March. So they're not going to go long on these contracts and take physical delivery. So you pulled a big amount of buyers out of that bidding war. So now the LNG people are bidding for those contracts. You're getting industrial users bidding for the contracts. But when you take the utilities out of there, so you end up with a lot of these paper traders, just guys that are trading these futures contracts on margin a lot of the time. They don't have any buyers. So you get to the end of the month and they have got to close their position because they literally cannot physically take the physical supply of oil or of gas. And if they went short, they can't come up with the gas. They would have to go into the spot market and buy gas to fulfill the contract. And the spot market's much different. This big polar vortex thing that's coming through New England, I saw just today that the spot market price in New York is north of $40 at the spot market in New York Citygate. And there was one spot market up there. I think the price was over $100 an MCF for spot market gas. So natural gas prices are set regionally. The oil price is set globally. And because gas can only be, there could be a real shortage of gas on the West Coast, but we don't have enough pipelines from the Permian Basin to go to the West Coast, so we can't take advantage of it. On the West Coast, because they got hit real early and it just continued to get hit by these winter storms on the West Coast, for 40 days, the gas price on the West Coast spot market price has been over $10 an MCF. So what you're seeing is that futures contract, but the actual spot market prices are much, much different.
I would also add that a lot of US and Canadian natural gas producers, because the natural gas price has a history of a lot of volatility, and for many years the natural gas prices were so low, they were not, they didn't want to expose a lot of their production to the wild swings in the natural gas price. So they tried to always hedge at a higher price than their production costs. So about 3 or 4 years ago, I think they were hedging at 3. Now costs for natural gas drilling are up. So I think a lot of these natural gas producers that had their hedges expire at like 3 or 4 over the last 12 months or so, 6 to 12 months, they were re-hedging at much higher natural gas prices at 6, 7, or even 8. So a good amount of their production is locked in. I know I saw with Sandridge Energy that when natural gas prices were still at 7 or 8, they were re-hedging at a good chunk of their production was hedged. Even though they're a higher cost producer, they're not a low cost natural gas producer because their wells are old, even though they don't deplete rapidly like some of the other producers. But they did hedge at a higher price.
And operating expenses on gas wells are much, much cheaper. A lot of the big companies that I follow, the gassers, they did not do a very good job hedging, though. The thing is, there was so much backwardation in the futures market, they couldn't really lock in high prices. Some of them, like Comstock, in the first 2 quarters of this year, they use collars, but they have $3 floors, but they have like $9 or $10 ceilings. They were anticipating that the price would stay high, and so they use collars instead of straight swaps. So you need to understand the hedging. Now, in all of our forecast models, I do my best to try to figure out how their hedges are going to impact their realized price. So I take into consideration regional differentials for gas and their hedging program. But they're still, Antero Resources is one of the ones I follow. They're one of the biggest producers of natural gas in the Marcellus Utica Play in Appalachia. In 2021, their revenues were $1.5 billion. In 2022, their revenues are over $3 billion. So their revenues doubled. Their operating cash flow doubled from $1.5 billion to $3 billion. And then this year, even with their hedges, which aren't very good, actually, they're still going to have a realized price over $4 on their gas. And they should generate about $2.4 billion in operating cash flow. And a lot of that being free cash flow, because their drilling program their capital program is going to be under $1 billion. So they'll generate $1 billion to $1.4 billion in free cash flow too. So these guys, people, it pulls back. They've been through this situation a long time. You got to remember that we were about 12 years in a period where, gas very seldom got over $3. We were flopping around in the $2 to $3 range for a long time. So they know how to do it. And also just their operating expenses are very low. Comstock, which is Jerry Jones's, controls that company, the owner of the Dallas Cowboys. But they have the lowest lifting costs I've ever seen. They have like 85 cents per MCF. So even if they're selling gas for $3, they're getting over a $2 profit margin on that gas. And so much of their acreage is held by production that they can slow down their drilling program for a while. And that's what will happen. If there's a little surplus of gas in the U.S. market, and it's a huge market, 100 billion cubic feet per day gas market now. If we're a little bit oversupplied for a while, they will adjust their drilling programs. They'll bring down supply and they'll get it into balance. And, maybe winter lasts longer. Maybe it lasts into April. Maybe we have a hot summer, and maybe we have, hurricane season takes out some production. It'll balance all by itself.
So I don't think the warmer weather necessarily counts for all this. Maybe the utilities, it's probably a good amount of different factors. So you also have, you didn't mention this, is the Freeport LNG, right, liquefied natural gas, that's offline, although it may start to come back. Small amounts of it may start to come back in the next month or so. We'll see. It was supposed to come back at the end of the summer, though. So it's been offline for about 6 months now. At some point, if that liquefied natural gas export facility in the United States comes back online, that will. But demand globally for natural gas is growing. I think what also happened, though, Dan,
rapidly.
long-term LNG demand is growing. Germany actually just installed like a third floating liquefied natural gas import facility. So they haven't built the onshore liquefied natural gas import facilities yet, but they just brought in another floating one. They spent $500 billion in the last like 4 or 5 months just on energy imports, just a absolutely mind-boggling number. It's a large chunk of their GDP. So while their elites were going to Davos, right, at the party last week, they were importing record amounts of coal, natural gas, wood to use for the winter.
I know. And and then in the United States, we are going to get more and more access to the global market. With Freeport offline, our export capacity was like of LNG was about 12 BCF per day. When Freeport gets fully back online, and I'm hearing that by the end of March, early April, they'll be fully back online. That'll add another 2 BCF a day of export capacity, so that'll help a lot. And which is like 2%. It doesn't sound like much, 2% of the total market, but it's the supply and demand at the margin that sets the price. So that's going to help. And then after 2023, starting in 2024, we're going to have a steady increase of more export facilities coming online that are all approved. They're all moving forward. They're all totally funded. They're going to get online, and we're going to take our export capacity from 14 BCF a day up to, I believe, 22 BCF a day by 2027. So the 3-4 year outlook for natural gas looks extremely good. And we just don't have the infrastructure. So then we'll have demand that exceeds our infrastructure to deliver it. So unless we get a government that's willing to approve more pipelines and get them underway, you don't build a pipeline overnight. So it's going to take some time. And a lot of them have given up trying to get approvals for more pipelines.
I thought the Biden administration a number of months ago was supposed to, or at least they said in public, that they were going to start approving low interest loans for liquefied natural gas export facilities to help with other countries. But I mean, what a politician says and does are normally two
true. That's true. And I'll tell you, Jason, I'm 99% sure that they intentionally held Freeport offline. It was ready to come back online in November. And they thought that if it came back online right in the middle of the winter, it would send utility bills through the roof. And so they intentionally put a bunch of, requirements in as barriers to entry. So here they're letting them come back online at the end of March, after the winter heating season is over. So.
After the elections too. Now,
after all the elections, I'll let them come back on.
Look at the policies, though. I mean, but the Biden administration said publicly they were going to use the Strategic Petroleum Reserve oil dump for lower gasoline prices for Americans. And then now we don't have any oil for national security and emergency after how much oil has been drained. Yeah. So, I mean, basically they've used policy tools, levers to manipulate oil and natural gas, at least partially.
Well, I will tell you, it's something on the oil side to consider. If the Republicans are successful in forcing the Biden administration to start refilling the SPR, that's going to be very bullish for the oil price. And if it happens like this summer, at the same time that the seasonal demand period is ramping up, I believe that's the thing that could push us back to $100 oil. I really do. That's a big deal.
Yeah, there's just a lot of hypocrisy in the Biden administration because he's allowing Chevron and other oil companies to bring oil tankers from Venezuela.
From Venezuela now, yeah.
Well, the Gulf refiners initially, right, in 2008, they had converted over to heavy sour because they were expecting to import a lot of cheap heavy sour crude from Venezuela, but that didn't work out because all the sanctions that got put on them.
Yeah, I think, if you start looking long term on this, we're going to need more heavy oil because you can't make diesel out of this real light oil that's coming out of the shale plays. It's just too high. You need a longer molecule.
Well, we should bring it down from Canada. But
that's the thing. Yeah, we should bring it down from Canada.
All the pipelines are being blocked, right?
I think the oil sands companies eventually are going to be a very good investment. I think they will too. There's massive reserves, and that's the kind of heavy oil that we need for diesel. So
I think those companies are pretty cheap. Some of the Canadian Natural Resources ones and Suncor. I think there's been mergers and acquisitions. They've been buying up the smaller companies and buying up acreage and stuff like that and consolidating that space.
Yeah. I focus mainly on the pretty small companies out of Canada. We've got some members up there that are very knowledgeable about what's going on in that space.
The other reason I think natural gas may have crashed was over the summer, there were articles coming out on oilprice.com that China was reselling their LNG that they had bought in storage in the tankers. They were reselling it, probably either gas that was piped from Russia and that was blocked, that the Europeans and United Kingdom wouldn't buy with the sanctions on the Russia-Ukraine war. So China was then reselling it at an enormous markup, over 100% markup for what they paid, reselling it back to Germany and the European Union.
Yeah, I know. Yeah, they're outsmarting us at every turn, it seems like.
They have some sophisticated commodities trading operations. So if they think the price of a certain commodity is too high, they'll either stop buying or they'll start selling some of their supply, or they'll go short.
Mm-hmm.
So I think that's part of what's happening. I think China's starting to buy back their supply now. So that I think that's why the price is staying low, because they're rebuilding what they sold at enormous profits over the summer. So what are some of the low-cost producers you cover in the Sweet 16 and the rest of your portfolio for natural gas producers in the U.S. and Canada?
Well, I'll just tell you the ones that are focused primarily, they get the majority of their revenues from the sale of gas. I mentioned one, Antero Resources. That symbol is AR. And like I told you, they're going to be extremely cash flow positive, free cash flow positive. The purest gas company that I follow, and it's 99% of it is natural gas. It's Comstock Resources. They're a Haynesville company in a deep Bossier. That's also in East Texas. They own a very valuable chunk of acres. They have about 1,600 drilling locations. It's a large company already. It produces 1.5 BCF per day. It has very low cost. Their operating expenses are, of all the companies I follow, the mid-sized to large cap gas companies, they're the lowest with about 85 cents per MCF of actual cash costs. And that includes G&A and interest expense and everything. And they, a couple of years ago in the panic, they did have a lot of debt, but they've successfully cleaned up their balance sheet. And Jerry Jones came in there. He contributed his assets up in the Bakken, which they've eventually sold off. But they've really recapitalized the company, and it's in very, very good shape now. And they pay a little dividend. They'll be funding a stock buyback program too, but I expect them to start paying a higher dividend. The largest natural gas company in the United States is called EQT Corp. A lot of people think it's going to be like Exxon or Chevron or somebody, but it's EQT. EQT is a symbol, and it produces like 5.5 BCF per day, and the next closest producer is under 4 BCF a day. Then Range Resources is also a Marcellus Utica company, and Range has a very good marketing company, marketing people, and they are able. I bet they're going to report some really high spot market prices on the East Coast. They can get some of their undedicated gas into those high price spot markets, and I think they're going to be doing well. And they do hedge. Quite a bit of their production is protected by hedges. Now, a little one I like, and it gets about last year it got like 58% of its revenues from natural gas, and the rest of it from liquid sales. It's called Silverbow, and it's kind of an undiscovered gem. The stock closed on Friday at $24.37. My current valuation is $81 a share, and that includes estimated cash settlements, our hedges, and regional differentials. But what I really like about it, they have quite a bit. They're an Eagle Ford company, South Texas Eagle Ford, Austin Chalk company, and they have already told us they are going to shift their drilling program to focus more this year on drilling oil wells. And they've got, a lot of drilling locations, so they can move their rigs around to what works best for them. There's one more that's in our high yield income portfolio, and it is Coterra Energy, and that is the product of the merger between Cabot Oil and Gas and Cimarex. And I followed Cimarex for decades. Very high respect for that company. Cabot was almost a pure gas company, but they're about 75% on a BOE basis. 75% of the production is gas, and the rest is oil and liquids. and they pay a nice dividend, about a 7.5-8% dividend yield on that company, and it has got some growth potential also of the share price. So I like those six, and they're good, solid, big companies. They are all free cash flow positive right now.
So since you've been in the industry for so long, has the oil and natural gas production mix shifted a lot over the decades? So a lot of these companies, when you first started off in the oil and natural gas industry, were a lot of these companies producing like 70-80% oil and only a tiny fraction natural gas? And now aren't a lot of these companies pretty close to 50-50 mix?
Well, yeah, a lot of them, very few of them. Comstock, like I said, is the only one that's like 99% gas. The rest of them, they'll have 25-30% of liquids also, because very few wells you drill they have both. A lot of these Permian wells, they're drilling for oil, but they produce a lot of associated gas and a lot of associated NGLs, natural gas liquids like propane, butane, whatever. And those are valuable too, in that, it's a very different market.
Yeah, those are other products that refiners or petrochemical companies want. Yeah.
Yeah. And these storms that have gone through the Midwest, you see these big ice storms in Texas and Oklahoma last week. That uses up a lot of propane. I'm telling you, because if you're heating your home with propane does not burn real hot. So you have to burn a lot of it to heat a home. And so that's going to jack up that demand. And even up there in the northern tier, where this new polar vortex thing's going through Ohio and into New York and stuff, a lot of those rural areas still burn a lot of propane. So that's a good one. And that's Antero is like the second largest producer of NGLs in the country. And they also have a lot of running room. Anyway, those are good ones.
So you don't expect then large dividend cuts from this weakness in the natural gas price in the short term, unless we see the natural gas price stay weak, say for another 6, 9, 12 months?
Yeah, all these guys pay variable dividends, so they'll have a fixed dividend, and so a lot of times, like if you look up on Yahoo Finance or through Fidelity or something, you'll see they show the dividend yield on just a fixed portion of their dividends. So you need to understand their variable portion, and a lot of times it's 3 or 4 or 5 times as high as their fixed dividend rate. So that is a percentage of their free cash flow. So they'll say, okay, here's my total operating cash flow. I subtract out my CapEx. I subtract out my fixed dividend, what's left, and they'll pay maybe 50 or 60% of that out as a special variable dividend. But even based on my forecast where I pulled down the prices, they're still pretty high. Now, they also are funding big stock repurchase programs. And, they're taxing these stock buyback programs. So I think the first thing they'll do is they'll cut those stock buyback programs to keep their dividends pretty high. So,
do you think that mergers and acquisitions in the oil and natural gas space in Canada and the US will continue? Or do you think that because of higher interest rates, the cost of capital for some of these companies, even though some of them may have high free cash flow like a Chevron or an ExxonMobil, that mergers and acquisitions is going to take a pause until capital is cheaper?
No, I actually think the M&A business could really pick up. A lot of times when you get the commodity prices pull back, it makes it easier to negotiate a deal. And also, these big companies, when you start talking about EOG, Devon, Diamondback, whatever, their stock is very valuable. So they can, acquire a lot of private companies recently have been bought out for maybe half the purchase price was stock, publicly traded stock, and the rest is debt. One company I follow that I really love, and I think it's really undiscovered, is Earthstone. I moved it into the Sweet 16. It's about a $14-15 stock. Earthstone Energy is symbol ESTE, and they have grown production by buying back these drilling programs, these private drilling companies. And their production at year end was 100,000 barrels a day. They went from 30,000 barrels a day in 2021. And by the end of 2022, they're up to 100,000 barrels a day. And they did it through 3 large acquisitions of private companies. So we're seeing more of that. But I tell you, where these guys are trading, some of them, they are prime takeover targets, because the big caps, if they can buy oil and gas reserves on Wall Street cheaper than drilling, they're going to do it. and they all have teams that are looking, business development teams that are looking for potential takeover targets.
Yeah, retail shareholders, I mean, maybe institutional shareholders get like the vision the management is selling for mergers and acquisitions more. They'll look like a couple years out, but a lot of retail shareholders complain whenever there's a merger and acquisition, especially if it's dilutive in the short term, because in the short term, it's going to make the stock weak, and then it could take at least a couple quarters. If it's a really large merger or acquisition, it could take a lot longer than that for the share price weakness to go away. But then eventually the business is stronger once the businesses combine, if there's synergy for an oil and natural gas company.
Well, I've known the team at Earthstone, and this is their third go around, and they know how to do this. And I don't think that the Wall Street gang has figured out how accretive these deals are. They are going to put up some fantastic numbers. And when they're going to announce their fourth quarter results on March the 8th, they're one of the last ones to announce, but they're going to announce a big increase in production from the third quarter to the fourth quarter. And they're going to be very cash flow positive. And it's 100,000 barrels a day is a pretty decent sized company. And they themselves are now a takeover target by a larger company.
Yeah, we're starting to see some really interesting rumors talking about ExxonMobil or Chevron buying BP, but I think there's just too much red tape, and I don't think they want to get involved.
Those deals are hard. They're big. Yeah.
Well, especially when you're crossing borders like that, because BP has so much to deal with the British government and their large pension funds and all these approvals. So I don't think Chevron and ExxonMobil are going to bother to do that. So it would be probably smarter for them to look at something domestic instead.
Yeah. I'll tell you, I worked on business development for Hess, and we took over like 3 companies for like $3.5 billion in the last couple of years that I was there. And when you take over a public company, you got to deal with the people problems real fast. Because if you don't, a lot of the key people have got stock options that are triggered by a change of control, and they leave. And if you get too many of your people that really understands what's going on in the company, it makes it very difficult to take over that company if everybody's heading for the exit door. So they don't understand the people problems. Got to be worked on too.
Wasn't there also a corruption issue a number of years ago? I think like where there was a side deal for like an extra 90 million or something, where one of the larger oil companies here in the U.S. was trying to take out a mid tier, and then like the senior executives were going to get like an extra 90 million, like their stock options triggered. Yeah,
they call them like golden parachutes or something. They put this thing in there. If there's a change of control, it just triggers all these warrants and stuff become in the money, and they're just multimillionaires overnight. Hey, I work with some guys at public accounting that went to small companies, and they very quickly became millionaires when their companies got taken over. But boy, these companies are trading for ridiculously low real valuations. I value companies based on operating cash flow. Some people value them based on the percentage of EBITDA, and EBITDA includes that's before interest and taxes. And I take that into consideration. I want to see pure operating cash flow, net of everything, net of all cash expenses. And then what is that on a per share basis? And that's how I value them. But, a company that's got a lot of running room, that's profitable, operating cash flow positive, free cash flow positive. They got a whole bunch of good drilling inventory. Those companies should be trading for at least 6, 7, 8 times cash flow. And man, our Sweet 16 as a group is trading for under 3 times cash flow as of Friday's close. It's crazy.
So what type of oil price are they pricing in, as if oil is going back to what, $45, $50?
Yeah. I mean, to get the valuations that these companies are at now, I can take the oil price down to below 50, and they would still look like good takeover targets to me. And I don't think oil is ever going back to 50.
Maybe temporarily
you would have to have a major recession. We would have to have a major long-term recession to pull down the oil demand.
But then I think, Dan, you'll see the Saudis and OPEC cut then. I mean, if oil gets
they would.
They would
No, they
cut
won't.
even more. I mean, the Saudis' costs are up a lot, so they're actually replacing a lot of their cheaper oil production from Gawar that's been depleted. They're
Yep.
drilling a lot
Yep.
of much higher cost deepwater offshore wells to replace the lost oil production.
Yeah. And your listeners should know they're in control of the oil price. If they would come out of one of these monthly meetings and say they're going to cut oil production by 2 million barrels a day, which is, they can do if they wanted to, you would see the price spike immediately. So they're in total control. Now, they don't want to do something. They don't want to throw the world into a recession by doing something like that. So they're going to be cautious. But at the end of the day, they are not going to sit back and let the price of oil drop. They're not going to do it.
Yeah,
And they hold the reins because nobody else is holding back production.
Well, ideally, they don't want the price too low, but they also don't want the price too high, because if the price is too high, it acts as like basically an interest rate increase from the Federal Reserve Bank. So it's very punitive on the global economy, on consumers, on businesses if the oil price is too high.
Yeah.
It puts a lot of extra inflation and higher cost of goods sold into all these products and services.
Yeah. And I'll tell you another thing. I'll tell your readers, I've followed these companies for a long time, and I've never seen balance sheets in this good a shape. They used the money from the last couple of years, and they've paid off a lot of their bank debt. Some of them have totally paid off their entire credit lines. A few of these companies have billion-dollar credit lines, and they have nothing drawn against those credit lines. So they don't need any money. They can fund all their drillings program with operating cash flow, and they're going to continue to pay off debt, pay dividends, and they don't want to pay. I've talked to several CEOs that said we went through that junk with these guys in 2020. Want to pull our debt and everything. We're done with them. We're going to run our business based on cash flow from now on. We're not going to go back to these debt holders.
It sounds efficient and smart and prudent.
Yeah, that's the way I'd run a business. That's how I run my own business. I'm not going into debt for this. So anyway.
Yeah, and it sounds like if they have that much free cash flow still and low cost, and they have some extra capital, they may go and look if the assets are that cheap. I mean, if they're pricing in $40 or $50 oil or really cheap natural gas, they can do some smart strategic acquisitions then.
Well, that's what Matador just did. Matador announced a $1.6 billion acquisition. I think it's called Advantage. And I looked at that deal's going to pay out in less than 2 years. They're going to get accretive cash flow enough that will pay off that 1.6 billion within 2 years, and that would be at like $70 oil. And if oil goes to 100, it'll pay off in a year. I mean, because they're adding like 25,000 barrels a day of production.
But in the short term, right, the share price is a weakness because they diluted the stock or they took on debt on the balance sheet. So in the short term, the share price is weak.
Did they? Let me see. I'll tell you right now. I don't know that they did issue. I think they did it with cash. They had access to this much capital. They had a lot of cash sitting on the balance sheet. Let's see. Advantage. No, it's not adding any shares. It's a $1.6 billion cash deal. It's expected to close in April. It's called Advantage Energy. And the stock went up after it was announced a few bucks. My valuation is $92, and it is about at, what's it at now? It's about at 65 or something now. But it really looks good, and it's going to be immediately accretive to their operating revenues.
And yet Wall Street and a lot of the hedge fund managers, these global macro guys that are short-term oriented, or a lot of them are very short oil. I mean, there's a small percentage that are actually starting to get long oil positions. I think I just heard Kyle Bass talk about adding more to regular energy positions lately, but the majority of them are still short a lot of these energy plays right now because they're expecting global recession or depression. But I think long-term, there's still supply issues. There's a lack of investment on the CapEx side. So I think energy is going to be in a bull market long-term because a lot of these countries, Germany is probably the worst one out of the bunch with the European Union problems. They need cheap electricity, and you need natural gas and nuclear power and even oil. In some cases, they're still using oil for heating oil or for the winter. So long-term, I think there's still demand there, even though the Davos ESG crowd wants to ban internal combustion engine. Wait,
Not going to happen.
California, they're already talking about what by 2030 there's a law or something that they're going to ban internal combustion engines.
And they'll all be flying around in their Lear jets and driving their big SUVs.
Oh, I can guarantee you that Gavin Newsom, his chauffeured limousine or his chauffeured like Cadillac Escalade or whatever is not even going to be a hybrid. Yeah, he's going to have a special permit exemption. Oh, with his holding his nose up high. Oh, I bought carbon credits for $30,000.
I know. It's insane. Oh, well, we'll see. Interesting world.
Well, Dan, I really enjoyed our discussion today. If our listeners want to check out Energy Prospectus Group, check out the Sweet 16 or your other newsletter products, how do they do so?
Well, we're a subscriber service, and it's $350 a year to join, and you get a monthly newsletter with our 3 model portfolios in it. But we also publish every quarter updates on all of our model portfolio companies, and they're, my independent valuation of them. I don't handle anybody's money. Our members are all self-directed investors. And I think if you have the knowledge and really know what these companies are made of and understand what they're going to be reporting over the next few quarters, it really gives you an advantage in the market. You can just go to Energy Prospectus, just Google it, or it's just energyprospectus.com, one word. And there's a link on the screen where you go join now. And anyway, we've really added a lot of new members. We've added like 150 members in the last 6 months, so it's really picking up. And like I said, our 2-year return on our Sweet 16 was 274%, while the rest of the market was in the tank. So we've done something right in the last few years, and we got some. Actually, this little pullback's created some great buying opportunities, I think.
Excellent. And for listeners who are wondering, Dan does not cover the large cap companies. So like ExxonMobil, Chevron, Royal Dutch Shell. I mean, those are covered by a lot of different analysts, a lot of different companies. There's articles on those all over the place. So Dan tends to focus on US and Canadian mid-tiers and small cap independents.
Right.